The banking industry has been one of the worst affected sectors in 2020, with the majority of banks still down on their 2019 highs. One of these companies is UK-based bank HSBC. HSBC recently saw their share price hit a 25-year low in September. Its share price has since recovered by over 50%. However, despite this impressive recovery, its share price is still down by over 30% over a 52-week period. In this video, we will analyse HSBC and compare them with other banks' stocks to assess whether it still makes sense to invest in the banking sector. So join us as we look at HSBC and bank stocks on today's Investment Store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes, from stocks and ETFs through to real estate and cryptocurrencies. If you enjoy this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video. HSBC Holdings plc is a British multinational investment bank and financial services holding company. It is amongst the world's largest banks with 38 million customers worldwide and is the largest bank in Europe with total assets of $2.7 trillion. HSBC's main markets are in Asia, particularly in China and Hong Kong, which make up almost 50% of the company's revenues. HSBC's third quarter results were posted in October, and this showed that its adjusted profit before tax had declined by 21% against the same period last year. Now, banks are completely different to other businesses, as instead of producing materials or manpower as their source of raw material for producing goods and services, they use debt as their raw material and mold this into financial products and services. It is sometimes unclear what constitutes debt, and because of this, we need to analyse bank stocks in a completely different way. And with that said, let's head into the analysis. We'll start by first looking at the economic moat of HSBC. Looking first at the intangible asset aspect of the HSBC business, HSBC is a well-known and trusted brand name and has a strong intangible presence. HSBC were recently accused of money laundering, following a scam that it failed to prevent. It was also embroiled in a political battle over its support of China's national security laws in Hong Kong, leading to the bank being criticised by both the US and UK governments. This could tarnish their image, so we score them 7 out of 10 for intangible asset. Moving on to switching costs or services. Traditional banking services are currently being disrupted by a number of digital technologies such as peer-to-peer payment apps, artificial intelligence, and blockchain technologies. HSBC recently suggested that it may introduce a charge for current account customers should interest rates go negative. This could potentially favour new entrants into the market and accelerate the disruption in the banking sector even further. So we score HSBC a 5 out of 10 for switching costs. In terms of cost effect, HSBC has been restructuring during the past few years, exiting profitable markets and reducing costs. Chief Executive Noel Quinn announced that the bank would accelerate an earlier restructuring plan, which includes axing 35,000 jobs. In October, HSBC recorded better than expected third quarter results on cost savings. Despite profits being down 46%, its operations in Asia continue to perform resiliently with tax profits of $3.2 billion. There is also optimism that the company will start paying dividends again, so we score HSBC a 7 out of 10 for cost effect. Looking next at the network effects of the HSBC business, HSBC has faced increasing regulatory and economic pressure in its key markets including Europe and Asia. It's rumoured that HSBC may exit from retail banking in the US to focus on more profitable businesses in the Asian market. In January 2020, hedge fund manager Kyle Bass predicted that Hong Kong was headed for a full-fledged banking crisis, similar to that faced by Ireland and Iceland following the global financial crisis. He attributes this risk to a slowing economy, falling retail sales, and a high ratio of banking assets to GDP. The latter value is allegedly reaching a level similar to those of Greece, Ireland, and Iceland during the collapse of their banking sectors. This would obviously mean bad news for HSBC, judging that Hong Kong represents such a large volume of their business, and for this reason, we score HSBC a 2 out of 10 for network effect. Finally, in terms of scalability, HSBC is shifting emphasis toward Asia because of the region's growing importance in global trade, increased urbanization, and growing middle class. HSBC's fortunes have further improved on expectations that President-elect Joe Biden will take a softer stance on China than his predecessor. We score HSBC an 8 out of 10 for scalability. This gives HSBC an overall economic moat score of 5 out of 10. Now let's look at HSBC's fundamentals. HSBC's operating margin has remained consistently below 20% for the past 5 years and has fallen under 25% only once in that period. We score them an 8 out of 10 for operating margin. For net margin, HSBC has achieved a margin above 20% twice in the past 5 years. This has been fluctuating and dropped to 12% last year. We score them 6 out of 10 for net margin. Moving on to the return on asset and ROCE, HSBC's ROA and ROCE have been consistently below 1% for the past 5 years. These numbers tend to be very low for banks due to the high level of asset and equity values that banks have. However, there's still good metrics to consider when analysing bank stocks. So we score HSBC a 4 out of 10 for both ROA and ROCE, taking consideration of typical banking norms. For debt to equity, HSBC's debt to equity ratio is high and has been increasing annually over the past 5 years, which we would need to pay close attention to if we were investing in this company. We've scored them a 4 out of 10 for debt to equity, again taking the banking industry average into consideration. We'll next consider two metrics that are specific to banking stocks. The first is net interest margin. This value measures the difference between the interest income generated by banks and other financial institutions and the amount of interest paid to their lenders. HSBC's net interest margin has been decreasing over the past 5 years, which is a concern. Therefore, we score them a 3 out of 10 for net interest margin. The other banking metric to consider is the Tier 1 leverage ratio, which was introduced by the Basel III regulations that were brought in place on the back of the global financial crisis. This ratio considers how leveraged a bank is in relation to its overall assets. The higher the Tier 1 leverage ratio is, the higher the likelihood that the bank is able to withstand any negative shock to its balance sheet. All banks with holdings above $700 billion must have a minimum leverage ratio of 5%. You can see that HSBC's ratio is just above this level, which isn't fantastic, so we score them a 3 out of 10 for leverage ratio. Finally, let's look at the price to book value for HSBC. Tangible book value is an important number when analysing bank stocks, as the value of a bank can be closely matched to its tangible book value, which is the total assets that it owns, minus liabilities and intangible assets. A price to book value below 1 is what we like to see here. However, you'll notice that HSBC's price to book value has been increasing over the past 5 years, and therefore we score them a 6 out of 10 for price to book ratio. This gives HSBC an overall fundamental score of 5 out of 10. In this section, we'll compare HSBC against some of the largest retail banks in the world. We will also complete our intrinsic value analysis of HSBC alongside these other banks. Let's first compare HSBC's net interest margin with its competitors. A net interest margin greater than 2% is what we're aiming for, and we can see that HSBC has the lowest net interest margin when compared to other banks, which falls below the 2% minimum threshold. For this reason, we score HSBC a 1 out of 10 for net interest margin. Looking next at the price to earnings ratio, HSBC has the fourth highest PE ratio when compared to its peers, so we score them a 4 out of 10 here. Next, looking at the PEG ratio, HSBC has the second lowest PEG amongst the group, so we scored them an 8 out of 10 for PEG. For dividend yield, most banks have suspended their dividends for 2020, but HSBC had the largest dividend yield in 2019, so we score them a 9 out of 10 for dividend yield. Next, looking at the Tier 1 leverage ratio, you'll notice that UK banks generally have lower leverage ratios than US banks. We score HSBC a 4 out of 10 for leverage ratio, as they're one of the lowest. The Tier 1 capital ratio is a measure of a bank's equity capital against its total risk-weighted assets, or effectively high-risk assets that it has on its books. According to the Basel III requirements, every bank is required to have a Tier 1 capital ratio greater than 6%. HSBC has the third highest Tier 1 capital ratio when compared to other banks, so we scored them a 7 out of 10 here. Next, let's look at the price to book ratio. HSBC has the fourth highest price to book ratio in this group, so we scored them a 6 out of 10 for PB ratio. Looking next at the change in share price over the past 12 months, HSBC has experienced the third highest drop in share price, which means there is greater potential for price recovery, so we scored them an 8 out of 10 here. Finally, let's consider the intrinsic value of HSBC and its peers. As mentioned earlier, the tangible book value is a reliable way to value a bank and provides far more accuracy than completing a discounted cash flow analysis. When we calculate HSBC's tangible book value per share, we get a value of 942 pence per share. HSBC's current share price at the time of making this video is 400 pence per share. HSBC has one of the highest price variances amongst its peers, with only Barclays having a higher variance. This shows that there is potentially some value here and definitely some upside in its share price. So we score HSBC a 9 out of 10 for intrinsic value. So in total, we give HSBC a comparison score of 6 out of 10 and an intrinsic value score of 9 out of 10. In summary, we have recorded the following scores for HSBC, giving them an ISS of 6 out of 10. HSBC certainly has value potential and plenty of upside in its share price. However, this does come with a fair amount of risk, both in terms of its fairly weak fundamentals and the risk exposure to the Hong Kong market. If we were to invest in this stock, we would apply a 10 to 15% margin of safety to the current share price. So would be seeking to buy the stock at a value of approximately 350 pence per share. This value would potentially mitigate any further downside risk and give scope for healthy long-term returns. Question for you: what is currently your favourite bank stock? Please let us know in the comments. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyse assets, then please subscribe to the channel and check out our website. We look forward to seeing you on the next video.